Let's get some analysis now on those latest figures. Javier Diaz-Gimenez is Professor of Economics at the IESE Business School, and he joins us now on the line from Menorca. Thank you very much indeed for joining us. We'll talk a bit more detail about the specifics of Spain shortly, where there was pretty feeble growth. But what's the most worrying thing, I would imagine, is that real fallback in German GDP. What's your reaction?
Yeah, definitely. The Spanish number was expected. It was pretty much in line with expectations. We are 0.5 for the entire year. That will be now about 1% if we keep going at this rate. The big surprise today was the German number, which certainly is dismal. In fact, Spain is growing at, one would say, twice the rate as Germany is. But of course, we're dealing with decimals, with points of 1%, and then rounding is all important. We should look at the second digit of the decimal points to have a clearer picture. Was this 0.2 of Spain 0.18, or was it 0.23? And when you are talking about such tiny numbers, this makes a difference.
When you're looking forward and you're looking forward to the next 6 to 12 months, do you think actually, given the figures that are from Germany and around the Eurozone really, that Spain is going to fall back into negative growth now?
Well, it is certainly possible. I mean, we are in very low growth territory, and I would not make a big to-do about whether positive or negative. It's still going to be very tiny growth for what is needed in Spain to achieve its economic and social goals.
So what should Spain actually be doing more of? It can't devalue, so just how can it start to boost its exports?
I guess everything is pointing towards another round of labor market reforms. Perhaps that's the weakest link in the chain in the Spanish economy, and it seems that that's what needs to be done as soon as our election is over. Because clearly, before that happens, it's not gonna be the case. It's not gonna happen.
It's interesting you mentioned the election. We know the Prime Minister Zapatero is on the way out. Do you really fear now that we're going to have 3-4 months of virtual paralysis? Instead of actually things getting done and reforms being enacted, we're just going to have political mudslinging, and this is just going to put the economy on the back burner when it should be on the front.
Well, yes, that's inevitable, I guess. But there was, on the sunny side, is that the election has been called forward, and we don't have to wait until March, which was the date when the official earlier date for the election. So yes, there's going to be another 3 months of low activity in the part of the government. There will be some extra measures that will all have to do with budget consolidation. I do not expect any kind of major reforms or major surprises. But come November, the election will be over. The platforms will make clear what their positions are with respect to the economy, and I think that opens up a different macroeconomic scenario for Spain.
Now, how long can Spain endure the elevated interest rates that they've got at the moment, and how does that impact on GDP growth?
Well, clearly it's a negative impact. It's very hard to quantify exactly how much it is. Of course, high interest rates mean increased costs for all firms, all businesses, and in general they do not help economic activity. But I don't think we need to make a huge to-do about the actual price. The important thing is that we need our lenders to keep on lending, and we need credit to flow to small and middle-sized firms. If that happens, it's not terribly worrisome. Just a few more points or decimal points in interest rates. I think that's manageable.
Can you see a time when euro bonds might actually come into reality?
Well, yeah, I think that's probably one. That's going to be part of the solution if the eurozone is to go on. But that will not come without a cost. Eurozone or euro bonds require a lot of fiscal coordination, and there must be some kind of limit, because we will have to allocate these bonds to different countries, and that will not be easy. So euro bonds means major structural reform, which would probably include reforms of the Maastricht Treaty and maybe of the constitutions that we are already seeing in places like in Italy.